To shed more light on what is the road ahead for transporting the world's largest democracy, I would like to invite the industry leaders on stage. I have enabled your audio and video, so you guys can start switching it on. First, we have Mr. Diego Greffi, who's the chairman and MD at Piaggio Vehicles. Next, we have Mr. Mukesh Haritash, who is the joint managing director, Chetak Group of Companies. We would like to welcome next Mr. Shankar R, who's CEO India of TVS Supply Chain Solutions. Then next is Mr. Vinkesh Gulati, who's president of Federation of Automobile Dealers Association, FADA. Then we have Mr. P. Kaniyappan, who's the managing director of WAPCO India Limited. And then we have Mr. Mohit Mehrotra, who's the MD of Omnicom India. And finally, the moderator for this keynote session will be Ms. Hetal Gandhi, who's director at CRISIL Research. So I welcome you all, and over to you, Hetal, to sort of initiate this discussion. Hetal hasn't logged on. I don't see Hetal. While my team connects with Hetal, I will start off the question answer session in the interest of time. So I will just start off with the first one. The first question is to you, Mr. Greffi. You can unmute yourself. I think you're on mute. You can. Yeah. Hi, how are you? So, plethora of regulatory changes have impacted the CV industry since the onset of 2018. Being axle load norms, BS6, scrappage policy, to name a few. Which ones do you believe will have the most, which prove to be most disruptive and will continue to have a lingering impact on the sector, and some of the regulation that we need to monitor closely over the next few years? If you can start with that.
Okay, first of all, good morning, everybody, and thank you for inviting me to this forum today. Okay, as you correctly say, I think last 3 years have seen a lot of changes and new regulation are coming in not only commercial vehicle sector, but overall into all automotive industry. You mentioned definitely Bharat 6, you mentioned scrappage policy, axle load norm, and I think that the pipeline is still very full for the next 2-3 years. To answer the question, I think that in order of, greatness of impact, as per my understanding, as per my vision, is Bharat 6 has been the most disruptive from many point of view. Just 2 or 3 factors that were to mention to support this statement is definitely the transition to Bharat 6. But I want to remember is taking basically emission level of vehicles very near, if not equal to the Euro 5, for example, in Europe. So now we are completely equivalent in terms of emission level requested from vehicle while driving on road. But this restriction, this regulation has definitely a cost. And the cost of the technology involved to meet this emission norm definitely is very high, very expensive. And so the entire industry had to adapt itself to the new normal, let me say, in terms of technology level application. Worth to mention that, for example, for one of the sectors which Piaggio is playing, that is three-wheeler, it has for diesel application, it has requested to apply full electronic fuel injection. That is something completely unknown in this sector before. This is definitely one aspect to be taken into consideration. Second aspect to be taken into consideration is also the change of usage of a vehicle. So again, due to the high level and complexity of the technology involved, also the entire service network that we had to arrange in order to be fully prepared for servicing this vehicle. You know that three-wheeler typically are serviced at mechanic or PGO that are around the quarter of every big metropolitan area of India. So we have to train them, provide them with tools in order to service the vehicle properly. So this definitely has been a disruption. So these 2 factors, I think, are the 2 that have mostly impacted how to say, the entire industry, and still the impact of it need to be absorbed going forward. And so my personal hope as player in this industry is that time will be given going forward to players, to OEM, to recover or to absorb all the investment, the effort done that was huge to ensure the transition to Bharat 6 before new regulation are coming forward. We know that we are already talking about CAFE norm, not for three-wheeler, but for other sectors, about OBD2. We are talking about ethanol, flex fuel. So all these changes definitely are most welcome because these take, how to say, evolution of the technology. But I think that time need to be given to the entire industry to absorb these changes properly, maintaining, how to say, the capability to invest, because the investment required for these changes definitely are huge and need to be properly, how to say, absorbed into cost before thinking about new changes.
So I think well said, Mr. Digo, on opening remarks of regulatory changes which are driving the Indian auto industry crazy. We are definitely at a junction where we are struggling to come out of the pandemic and hoping that the lockdowns are not going to repeat themselves. But this year has been, in a way, a year of many difference, and newer struggles have, in a way, come up. While India today is reaching vaccination levels of almost 1 billion mark before the end of this month, which is a feat in itself, and exports are roaring, but there are logistic issues, raw material prices, as referred as the green cycle, and power crisis in general, plus chipset constraints in electronics and automobile industry in specific, which are the new set of issues that we are dealing with. In a nutshell, our uncertainties have changed and volatilities have now become a part of our life. The CV industry in totality has been on a roller coaster ride as well. I think axle norms to begin with, NBFC crisis, and then the pandemic, along with all the logistic issues, has surely impacted recovery curves in the commercial vehicle sector. Volumes for the overall commercial vehicle industry at the closure of FY21 were 56% of the volumes at the closure of FY19. And the recovery curves that we are seeing, while growth rates are encouraging, we might still not see, very high volumes such that we reach volumes of the pre-pandemic levels at the closure of FY22. So, Mr. Digo, in continuation with everything that you highlighted, what do you believe could be the growth rates that India could look at? And how do you believe is the recovery curve different for India as compared to many other parts of the world?
Yes, thank you for the question. In the sense that, as I often like to mention when we are having a business review meeting at the group level with our, headquarters, I'm mentioning that I think that India overall and automotive industry overall in India this year, this calendar year 2021, more than last year, has passed through what I like to call a perfect storm, in which, let me say, all possible negative factors that have impacted the demand, margins, profitability of company, and capability to invest have come forward at the same level. We mentioned a regulation change for sure. You mentioned COVID, definitely, but worth to mention also some other factors that you also name, like raw material, commodity prices going up dramatically at unbearable level, honestly. Shortage of material, chips, but not only that, also shortage of container. You mentioned that export demand has been quite healthy, but now we are struggling to find containers to dispatch our vehicle to Europe or to Africa. So let me say, as I said, all the possible negative factors that one player, one company playing this field would have been thinking of, it has happened actually. So I don't think that there is anything remaining out of the box that can come forward and further impact negatively the recovery growth. But if demand, one positive factor that we have seen is that, for example, notwithstanding all this, how to say, very negative environment, to be honest, the demand of three-wheeler and two-wheeler also has been quite healthy, at least for the first period of 2021. That means that overall the sector is very resilient, is very strong, is capable to overcome these difficulties and going forward. So maintaining growth curve, notwithstanding all the negative factors that we are there, mainly for commercial vehicle and mainly for two-wheeler, that is our focus business, means that the demand is very robust. And so my expectation going forward, if we can at least get rid of anxiety for COVID, that definitely is one very important factor. And mobility, shared mobility will start at the pace that is usual here in India. At least that, and if we can see at least a stabilization in commodity prices, raw material prices, if these two factors are going to happen, I think that the growth curve that we will see in the next quarter after quarter, will be definitely consistent and relevant. So we expect for three-wheeler, talking about the sector that is more near to us, to reach at least 80–90% of a normal level of demand by mid of next year. So this is our expectation, provided that at least this no new regulation will be imposed in short term. So some time need to be given to the industry to absorb all the efforts of the perfect storm that I was mentioning before. So some consideration need to be taken. If new regulation is coming forward in the next, in 2023, at least the time until 2025 is given. Commodity prices will stabilize and no new COVID wave will come. I think that we can look at 2022, 2023 with a more positive outcome, planning for a good, consistent growth. This is my view.
Right. So I think Mr. Digo clearly is spotting out commodity prices stabilization, and no further regulations or a COVID wave can result into pre-COVID volumes coming at least by FY23, specifically for the segments that he addresses. I would like to take the question to Mr. Kanyapan over here. Mr. Kanyapan, looking at it from an India lens point of view and having seen the industry for so many years, do you believe that the factors which have impacted the commercial vehicle industry until now, any of them will bring about a long-term structural impact on the sector, or it is a cycle like previous cycles which we experience in the CV industry, most of the times every 5 years, and this shall also pass? What are your views on this, structural versus cyclical?
Yeah, thank you, Madam. So one major change that the commercial vehicle industry faced in 2018 was the new regulation on the increased axle load. If anything, my view, that may have some impact on the structural dimension, because everybody had to redesign the vehicles to accommodate the increased axle load. The carrying capacity of the trucks increased, etc. But I would say, and the rest of the things are largely cyclical. But two new, forthcoming trends, in my view, could be making a big impact structurally. Number one, I think the industry is moving towards an inflection point as far as the technology trends are concerned. Autonomous, connected, electric, which will completely change the structure of the industry, the players who will be there in the business, and the supply chain, and every aspect of the business will be changing. So in order to succeed in those emerging things, companies have to navigate successfully through that. So the past success is no longer assurance of the future success. This is one aspect. The second is, of course, I strongly believe the scrappage policy, vehicle scrappage policy that has been announced, which will also completely change the structure of the industry. because with the BS6 and all the more efficient and very advanced trucks that are the commercial vehicles in the market, the whole ecosystem will be completely changed towards safety and better environmental, impact. So these two things, I believe, will be a major impact on the industry.
Yeah, I think very good points made by Mr. Kaniappan. I would jump on to Mr. Shankar with the same set of questions. Mr. Kaniappan made 2 points. One, he would like to monitor the scrappage policy and the way structurally it will impact the sector. And two, he spoke about role of technology. So here I would like you to chip in, Mr. Shankar, and my question to you is very simple. How do you believe the scrappage policy is going to impact the structure of the industry? And second, what is it that you believe is going to be the acceptance levels in terms of newer technology changes, especially by the fleet operators? Over to you, Mr. Shankar.
Thank you, Hetal. Thank you. And nice to be in this forum again. And my warm welcome to all my fellow panelists and the audience. Very valid question you have asked, and Mr. Kaniappan very rightly spoke about two things. One is technology and scrappage policy. Let me start from scrappage policy first. This is a long-awaited policy of the industry. The manufacturers, the service providers, and to a large extent, even the operators, because at the end of the day, we as a country were using two older trucks, though we were moving away from say BS1 to BS6 over a period of 2 decades. Still, there were nothing prevented anyone from using an older vehicle. From an environmental standpoint, that was definitely not the right way of approaching it. And therefore, there was a need to move the old vehicles out. Obviously, everyone looks out for some incentivization that comes in when we do it. And who's going to bear the cost of incentivization for replacement? Because the trucks move from one level to second hand, third hand, and it goes on and gets used in maybe rural or semi-urban areas, etc. But the cycle has to start, and therefore the government has kick-started the policy. The policy as it is today may not be that appealing for everyone to just take a decision to replace it. And even if they were to do it, the demand curve has to also, come along and enable that to happen. Mere scrappage policy, when all the what Diego spoke about in the terms of a perfect storm, when all that is around the corner, both from a supply side as well as from, more importantly, from the demand side, the scrappage policy may not be a great enabler. But I'm a great believer in the future, and therefore I think we have crossed over everything, and we have come to an inflection point where it's only going to take off. And at this point in time, definitely with a little bit of a tweaking and enablement by all the players, and the players would be in the OEMs, the players would be in the operators, and definitely the banks and the financial institutions, because they should come forward. 95% plus of these vehicles are funded, and a large portion of them by NBFCs, and the crisis which NBFCs went through or still undergoing, it's not going to become that easy for the cycle to kickstart. So these things, if it is done properly, the scrappage policy would be an enabler of demand and will definitely be in the right direction for people to replace vehicles. But only replacement of vehicles won't happen. There has to be a capacity addition as well. And for capacity addition to happen, the demand across the economy has to improve. We are predicting 9.5% GDP growth over a muted last year. If it gets into double digit for this year and then into a high 7 to 8%, then this demand cycle will certainly take off, and scrappage policy will enable it. The second part of the question, what you asked me was, is technology going to be an enabler and what are we going to do? I think there are multiple things in that. One is, of course, the government is taking a policy on how do we, reduce the overall impact on, though we have not signed the protocol of making a net zero emission norms by whatever 2030 or 2040 or 45, as many other countries are signing. But I think the impact on ESG, both on the government as well as on society as large, is going to be very high. And therefore, we can see alternate fuels which are more environmental friendly definitely coming up. Electrification is one of the things that's happening in the lower end. Maybe three-wheelers, I heard maybe my figures may not be updated, almost about 40 to 50% are already on the adoption of at least in many locations or in the top cities. So that in my mind will happen. And like what Mr. Kaniyappan said, this will change the whole system again. Who's going to be an operator for last many years may not change that fast. And therefore, there are different, you will have LNGs, you will have high fuel cells, etc., all coming in. So technology is also going to be a structural change that will enable change. But for all these things to happen, the demand cycle, in my opinion, has to first kick off. Then these are kind of things which will change over a 3 to 5 year time frame. But we need to go through this curve, and unfortunately, it is not really bottomed out, though every day we expect, or every month we expect this is the bottoming, but it has not yet happened in my mind.
Yeah, I think that's okay. Thanks, Mr. Shankar. I think there are important points that he made. One was scrappage policy in the current form may not really appeal. So some changes and it can really trigger replacement demand. Two, the replacement curve is not sufficient and you need actual fleet additions or demand to actually pick up. So that brings me to, Mr. Mukesh. Can I have your views on what you see as the demand recovery? We have been seeing that, freight rates have picked up from the lows where they were, but not really before the pre-COVID levels. We are seeing diesel consumption by itself has not really picked up substantially. And it's actually lagging petrol consumption, still below pre-COVID levels. And fleet utilizations we hear from the market is not really very great. So where do you expect, or how do you expect, with the 9.5% GDP growth this year, 7.5% to 8% over the next 2 to 3 years, where do you expect the demand recovery curve to really pick up from a fleet addition point of view? Over to you, Mr. Mukesh.
Good morning, everybody. As you said, I'll cover the first point, the recovery. Okay, the curve, how it's going to be, for the new vehicles addition and the capacity. So if you look at historically, last 2 years, because of the pandemic and all, there was a lot of roller coaster we have seen and witnessed. Okay, so if you look at this new addition, there's a lot of disruption happening within the logistics industry or complete supply chain. And if you look at this specifically, there are 3 categories we have. One is the SCM, small commercial vehicles. Then we have intermediate commercial vehicles. Then we have medium and heavy commercial vehicles. I will start with the small commercial vehicles. There's a good demand for the small commercial vehicles, which is happening because of the e-commerce and this FMGC and all this stuff which has come. So you have a lot of requirement for the small commercial vehicles to cater to the last mile customer. Okay, the deliveries to be made. So for that, you have a lot of requirement which is coming up. Then we talk about the intermediate commercial vehicles. Yes, of course, there is a demand for the intermediate commercial vehicles. There are 2 reasons for that. One is there is an alternate fuel which has is being in demand, like because of the price of the diesel has gone up drastically. So with that, there is a lot of demand for the intermediate commercial vehicles, and people are going for the alternate fuel. For the CNG, for example, if you look at from Delhi to Mumbai, it's all complete highway is being covered by the CNG fuel. Okay, so now there is a big demand for this vehicle, and all of a sudden, because of the demand, the OEMs are not able to fulfill the demand. Okay, so that's the another challenge which is I foresee at the perspective of the OEMs. Then you have this heavy and the medium commercial vehicle. There is no offtake for the heavy and medium commercial vehicles as such, if you compare with the pre-pandemic situation, and which I foresee it is not going to improve up to 24 and 25. The reason being there is a competition from the railway also, because the railway also has eaten up a major chunk of the business from the road industry. So which also is one of the key factor, which is not, because of that, there's no demand in the commercial vehicle for the heavy commercial vehicle especially. And the alternate fuel, as I was mentioning, the CNG, there is a shift for the small commercial vehicle in the EV segment also. A lot of demand for the EV for the smaller segment, and a lot of new player also has mushroomed, So that segment is going to go up, and I feel by 2025, we have around 40 to 50% of the electric vehicle in small commercial vehicles for the last mile delivery, which is going to happen. And if medium and heavy commercial vehicle, as I told you, the demand is not as such picked up, and still there's a long way to for the recovery for the medium and heavy commercial vehicle. So one more thing which is also being witnessed, because for the alternate fuel, there's LNG also is in small western coastal area and all, So there is a bit demand for LNG also, and people are talking about to shift their vehicle from the diesel conventional vehicles to the LNG because of the cost factor and all. So with all that, I foresee there's still a long way for the middle commercial vehicles to demand come back to the pre-pandemic.
Yeah. So I think Mr. Mukesh has touched upon important points, just like Mr. Shankar. Both of them spoken about alternate fuels. I'm going to hold up to that thought right now. But clearly, it is the SCV segment that is seeing a better recovery of take driven by e-commerce demand, last mile connectivity that is needed. MHCV, we are seeing very modest recovery trends. While the growth rates might appear high, volumes as compared to pre-COVID levels remain substantially lower. I would like to take this conversation a little ahead. This entire thing on what has happened in the MSCV and SCV space has also been influenced a lot by BS6 implementation and the role that technology has now started playing in our vehicles. More number of sensors and more number of technology linked interventions, if I may say so, have now started becoming a norm in the not so technologically adaptive commercial vehicle sector in India. I would like to bring in Mr. Mohit Mehrotra over here and would like to understand what is his view on the role that regulations would play in technology adaptation over the next few years.
Yeah, hi, Ethel, and a very good morning to all my fellow panelists and to the audience. Thanks for having us here. Omnicom is a global manufacturer of connected vehicle systems, and with the predominant focus around fuel and fuel monitoring technologies. So we naturally, therefore, tend to monitor that kind of a technology adoption curve for heavy commercial vehicles. So our assessment, Ethel, is that clearly for the last couple of years, ever since the government has started to make a serious intent around the implementation of connectivity in terms of AIS 140, although the implementation is very patchy still, at least the intent is in the right direction and the signal seems to be going out there. All of this is definitely helping in a large way increase the number of trucks that are connected. And it's important for a couple of reasons. It's important because the moment you have good connectivity on the truck, you start to bring in efficiencies, you start to bring in awareness for the regulators in terms of where the trucks are moving. So there's a high linkage between connectivity as well as toll collection, connectivity as well as the whole e-way bill system that is being talked about as being something that will eventually get linked. And the second piece around the way operators operate their fleet in terms of just knowing, just having a good handle on where the assets are and how fast they're moving. There are, of course, other interventions. So once you have a connected truck, all of these things start to play on. Now, what we've seen is that if you look at the overall numbers, with about 10 to 11 million trucks on the road, right? Approximately anywhere between 1.5 to 2 million are connected at the moment. And so that takes the connectivity number from an abysmally low number of about less than 5% to a couple of 4 or 5 years ago to a significant expansion where over 1 million trucks today are connected, right? And while that is nowhere near the global or into the ideal numbers that should be, at the same time, a 15 or 20% connected fleet is a decent number to get started with. So in days to come, I see definitely AIS 140 implementation. It's there on everybody's mind. It's there on every trucker's mind. I think the only reason that people are really not adapting to it is because there are lots of bottlenecks on the way of actual execution of some of these things. My trucker customers tell me that it's very hard to actually, even though the government has an intent to have this data ready, the data utilization is something that is not yet been looked into. So therefore, and then it's a state subject, so it's not a national subject. So every state is taking its own time to adapt. So this is one. So coming back to your question around regulation, yes, definitely this is a positive step. It's taking it in the right direction. What does it do once the number of trucks are connected? It just drives productivity. It drives savings. I can't hesitate. I can't sort of lose the temptation to talk about the kind of technologies that we talk about here, which is, for example, fuel management. And we've seen that a very large section of customers who are both in the logistics as well as the construction machinery sector are benefit significantly from having these types of information available on real-time basis. And that's sort of driving an adoption of even more technologies. I now see a lot of focus coming in the ADAS and the whole collision avoidance kind of technologies, the driver safety technologies, and a lot of our industry peers are getting into some of those spaces as well. So,
okay. So Mr. Mehrotra, I think you have made an important point. And, clearly regulations are going to be over here to stay. And with every passing increasing regulations in future, focus on safety is also set to increase on the commercial vehicle side. With each passing regulation, adoption of technology is only going to increase, and the power of connected vehicles is yet to unleash for India. I will park the technology part now. And if you realize, we have touched upon OEMs and what are they seeing the market as. We have touched upon component players, how they are looking at the market. We have spoken to logistics players, and we have spoken to technology players. An important part of the value chain in any part of the auto industry is also the automotive dealer. And I think while we speak about technology and while we speak about recovery curves, they can provide us real voice from the bottom of the market. So let me go to Mr. Vinkesh Gulati, and I would like to hear two things from you so that I can wrap up, my part on regulations and recovery curves. A, what is the sense that dealers have on the ground? SCV versus MHCV. Are there any signs of MHCV volumes set to pick up, or we are still far away? We want to understand that from you. And B, we want to understand from you, acceptance of BS6 vehicles on the ground. How is that moving, and are there any practical issues that dealers are seeing when they are actually selling those vehicles? Yes, Mr. Vinkesh.
So thanks, Hital. Thank you very much. Thanks, Rohit, for having me in this show. Frankly, obviously, the commercial vehicle is the segment which has gone through a lot of regulations, as already informed by all the panelists, esteemed panelists. And the biggest problem has been the price increase because of the BS6 had been the highest in case of percentage if we compare with all the categories of auto in which dealers are. And right. Obviously, the kind of adaptation for that from BS4 to BS6 for the commercial fleet operator was a difficult part. One, obviously, it made the operation complex because of an additional fuel and additional compliances on checking on the fuel and all. And obviously, the price increase, which was around 10% or more. And in that segment, which was already reeling with the tough part from 2018, means when the XL norms started. So obviously a tough time for the commercial vehicle operators and the dealers to handle that price increase. But now it's been 1.5 years since BS6 has been launched. Things have been normalized now. The operators have also understood the nuances or the benefits, both pros and cons of this BS6 compliance, which we have started. And even our dealership has also adapted to it. So overall, it's now being adapted well. No doubt, the kind of benefit we were looking at from BS6 around the pollution and all that, it's still a long way to go if I see from the CV segment. Coming back to the kind of numbers on the ground reality or the demand, No doubt everybody is aware of, and we have just discussed, the small commercial vehicle or the LCVs had seen a good push post the lockdown last year due to the e-commerce and the local FTUs using those products. That was the first segment in the commercial segment which saw the growth. Slowly and steadily this year we are seeing a bit of growth or normalcy coming in the medium commercial vehicle also. So just September we have seen a growth, but obviously it is a growth from last year, which is a low base. If I compare to year before last, it's still minus. The biggest segment which is still struggling is the HCV, or the heavy commercial vehicle, where I feel on the ground reality, the issue of fuel prices high, the issue of freight rates not being as compared to the price hike and the ground issues, and additionally the kind of competition now coming with the railways coming in. Even all the companies post this lockdown are trying a hand there with the railways. So all the long distance freight carrying is shifting to railways. That is creating a big competition towards our road freight carriers. So heavy commercial vehicle is still struggling on that concept. But one, the kind of increase in road infrastructure and construction, what we have seen, is also helping the commercial vehicle segment on the category where the vehicles are used for construction. So these products like tippers and all those things are regularly on green, and the way we're expecting elections around the corner, the government will spend more on the infra part. So I feel that segment will see a regular good growth going further. And overall, from last year, commercial vehicle is still on green, but it's still 23% down from the dealer side or the retail side if I compare with the F20. So which is a big degrowth, and even during the festive, we are not seeing the sheen or the cheer in the sales of commercial vehicles. So hopefully in maybe another 4-6 months, things will regularize and we'll see back the good numbers in commercial vehicle.
Mr. Vinkesh, extended to that question, given that we're talking about recovery curves, I'm compelled to ask you, how are discounts today in the MHCV space where recovery curves are muted? And also, how is the viability of the dealers in the MHCV space looking like, given the fact that you are seeing a situation where volumes are yet to pick up substantially? So your comments on that.
So very pertinent question, Ms. Hetal, for the dealer community, obviously. Very tough times for us, seeing 2 consecutive lockdowns in 2 years for 2 months, where as a dealer we had gone through equal to nil revenues. No doubt, as commercial vehicle dealers, our workshops are on, but even during lockdown, but it was a very a tough situation because the vehicles were running low and we were there to support only essential commodity, essential used vehicles. So overall, that was in an extent an additional loss thing for us, because we were running the workshop on 20-30% capacity, but overall 100% overheads like electricity and rent and everything. But the vehicle inflow was just 10 to 20% because most of the vehicles were off-road. So tough times. Obviously, the viability for the commercial vehicle segment was a big concern. But normally when tough times come, we learn a lot, and it's the harder way to learn things. So a lot of efficiencies have come in the dealerships. We had now we know that even with the 70% cost, we can still deliver 100% output. So for the past 1.5 years, all the dealers have reduced their overheads, and in not even only in manpower, because that was a part where we couldn't, because those were our family members, but the other overheads we could have controlled. So we have done that. So even with that control overheads, we are now on break even, we can say, because the manufacturers on the whole have supported us a lot in this period. Mr. Diogi is there, and he had been very open to support the dealers in this point on during the lockdowns and post that also, in way of incentives or payouts or support systems. So overall, the manufacturers have supported us, no doubt. But obviously, we are not here to just be supported or do a break even. We are here as a dealer to earn, because we have invested a lot. The manpower is there. So a tough time for us. And but like I said, the small commercial vehicles supported the dealers at the tough times. As of today, medium is also coming up. And last year, we have seen a time from April to August where the commercial vehicle, because of the BS4, BS6 transition, the production was very less. So that was a time where it was a big problem for us to manage the customers and our manpower and the viability. But since the production started and things were there, things are improving day by day. But it's still a long way to go for the commercial vehicle segment dealers.
Yeah, I think, thank you, Mr. Venkesh. Very important point made, which I'm going to come back to, which is on fuel prices, and therefore, what is the impact on your fleet operators. For the benefit of the viewers, we have divided this entire conversation on the basis of 5 pillars that are actually impacting the CV industry: regulations, recovery curves. We have closed conversation on both these topics. The next one is what a lot of panelists touched upon and is a very important trend emerging in the future: alternate fuel adoption. To begin with, in segments like SCV, Mr. Digo and Mr. Shankar also mentioned that alternate fuel transitions are catching up. Let me speak to them about a more long-term adoption, which is on the electric vehicle side of it. So, Mr. Digo, the next question goes to you. You did speak about, Indian consumers gradually leaning towards alternate fuels, how CNG is picking up. Could you throw some light on, how do you believe adoption of electric vehicles is set to be specifically in the SCV, which is small commercial vehicle space? And what do you believe is going to, drive that transition from an India point of view? Feel free to bring in some best practices from international markets in the CV space where you would be seeing some transition trends already. Over to you, Mr. D.
Yeah, okay, but one important point to start from is that when I was talking before about the perfect storm, one of the factors that I missed to mention, but that was mentioned by my fellow panelists, was definitely fuel price. And fuel price has reached, again, is another factor that has definitely a big hurdle for growth of demand of mainly of most commercial vehicle, that is a sector that is traditionally linked to conventional powertrain solution, like diesel or mainly diesel, let me say, I would say. So, in fact, that price of diesel in many parts of India has break the threshold of 100 rupees per liter that was never seen before. Definitely has been a big breakthrough from negative point of view. It's a matter of fact that, as also Mr. Gulati was remembering, when we saw last period of festive season, the Sera period, the level of sellout that we have seen in the market is far below what we have experienced last year. And one of the main contributing factors for that definitely is level of fuel price that has been convincing, and coming to the topic that you are introducing, taking customer progressively to shift towards a different kind of mobility solution, like alternative fuel, CNG, mainly for small commercial vehicle, and EV. So it's a matter of fact that the overall level of sales in the market that you experience, I'm talking about specifically small commercial vehicle and two-wheeler in last festive season, the Sera, last few days, have been impacted negatively, but on the other side, sales of CNG vehicle and sales on EV vehicle is undoubtedly 3 or 4 times more than what we experienced last year. Means that the shift in the industry is already there. and is mainly driven by two factors. One important factor is the fact that the availability of CNG pan-India is increasing. And whenever customers have the possibility to adopt for a CNG solution and giving up traditional diesel or other kind of solution like petrol, whatever it is, they adopt CNG always due to the better drivability of a vehicle, less noise, better NVH, less pollution for sure, but also lower cost of operation that is more important from their wallet point of view. Because this work commercial, that for small commercial vehicle, these are customers that use vehicle for earnability, for livelihood. So we are very sensitive definitely to the earnability they can take out from their vehicle. Same is valid for EV, both for CV and both for two-wheeler, for example. We have seen a growth of demand that is per 5 respect to the same period of last year. Fact that FAME 2 incentive scheme and government policies have been now come full in place and are giving huge contribution to customer whenever we adopting for EV, along with the fact that road tax, registration tax, GST are definitely much, let me say, much lower or negligible respect to conventional IC solution, is definitely driving demand of EV dramatically. And we have seen that experience ourselves, mainly in three-wheeler space. So going forward, if you want my view of, for example, talking about a small commercial vehicle space, my view is that in it was a sector that was traditionally dominated by diesel. Diesel, 90% of the solution, the vehicle that applying on road, also in three-wheeler and four-wheeler, small cargo, we have diesel. Diesel monocylinder application. Going forward, I personally expect that it will happen, a big shift will happen, and in the next 2 to 3 years, the percentage of share among the various powertrain solutions will be equally divided between EV, CNG, and diesel. Diesel will maintain, will remain in some maybe suburban and rural areas where accessibility to CNG infrastructure for recharge or to EV infrastructure for recharge is not so easy. It will remain. But in all the other parts of the country, I expect that also due to, as you already mentioned, the push of e-commerce, last mile delivery, e-commerce after COVID has boomed in India, as a matter of fact, will take up EV to at least 1/3 of overall absorption in terms of demand. So I expect by 2023, 33% will be EV, 33% will be CNG, and 33% will be diesel. Very fast, I think this is going to happen.
That's a very, very valid point. Cost of ownership, cost of acquisition will impact dynamics of fuel adoptions. CNG adoption is clearly driven by infrastructure being set up, and an equal split between the three technologies over a period of time is clearly what Mr. Digo is highlighting, specifically for the SCV segment. I would like to move to Mr. Shankar, who are the users of these technology. Where is it that you are seeing adaptability of CNG coming up, and what is the role that business models like battery swapping or battery leasing can play for faster adoption of electric vehicles or electric technology on the SCV side? Over to you, Mr. Shankar.
Thank you. Yeah, like what has been pointed out, CNG is definitely picking up quite a bit in the LCV and the ICV space. A couple of reasons. One is obviously the availability infrastructure has increased, and therefore even on highways, long distance, 1,000 kilometers plus, if the lead distances were, it is easy for on the highways for people to go even for larger lead distances and not worry too much about the infrastructure. Earlier, it was centered around a few 30 odd cities. Today, it is not. So you have infrastructure on the highways. Second most important point is the TCO is operating positive, better than the diesel TCO. And that is the higher one is availability, which is an enabler, but the TCO is definitely enabling people for faster adoption. So after all, commercial vehicle by nature has to be a business proposition. There has to be an operating economics, and the operating economics has to be positive than other alternate fuels for faster adoption. And that is clearly coming forward, that compared to diesel, and with the way the diesel prices have gone up in the last couple of years, this is one major reason why the things have shifted. So that's where I see CNG getting adopted more. Maybe in an MNHCV, the government has made a statement. In fact, our Minister for Road Transport and Highways and Transport, Mr. Nitin Gadkari, has very clearly said when he opened the first LNG station, that LNG is also going to be available, and maybe MHCV will make a major transition when LNG infrastructure comes in the next, say, 3 years or so. And there are players who are looking at it as a potential, kind of a major change in an alternate fuel at the higher vehicle end. Coming back to your other question of business models for the adoption of SCVs and electrification of SCVs, you are absolutely right. The charging infrastructure has to increase. There is still a higher cost of acquisition, and definitely the TCO is not all that positive for the LCV. It's just coming on par, but one has to take a longer term view. In this, there is also a potential disruption from a financing side and vehicle ownership side that can happen, that maybe we don't have to own vehicles. There can be a concept of servitization of vehicles, in the sense that there can be financing arms, and OEMs are looking at it when they're coming with electric vehicles, which will actually own the vehicle and lease it to an operator and make it absolutely a variable cost to the operator. How attractive these schemes are, how much are they going to put, a minimum number of kilometers or a minimum number of fixed payments that are going to come in, will also help in seeing whether these models are going to. One, there is clearly a demand. E-commerce companies, last mile companies, both by a corporate need for far higher ESG governance. Second, by regulatory needs that are coming in. Infrastructure that is coming up in terms of charging points, battery swapping could be one of the technology that can happen, which will help and enable this. And also with business models, or at least financing models, totally changing, will enable faster adoption, is in my view one of the points for at least LCV adoption to happen. Still LCV vehicles have not come on the road in a big way. Everybody's in trial and testing methodology, or maybe a few vehicles are being used. I think that will be the next big shift that will happen, at least in city delivery. Maybe 15 years ago, what CNG was to, say, started off with NCR region and then moved on to other bigger cities like Ahmedabad, Mumbai, etc. Today, electrification may be in that area. There is a stated Niti Aayog document which says that, in 5 years, maybe they want two-wheelers, three-wheelers, 80% and 50% by 2020 for smaller vehicles. I don't know whether that will be there or it will go into a 30-30 mode that Mr. Jijo spoke about. One has to wait and see. But these are all certain enablers, certain things that will change the way the industry is structured currently, and current ownership models will also necessarily have to change for faster adoption.
Absolutely. I think a lot of changes expected over there. Vehicle leasing, battery swapping, all this are going to change business models under which OEMs as well as fleet operators are performing or existing today. Now that brings me to a structural question. When the ecosystem is changing so much on fuel technology side, it has a rampant impact on auto component players. And it has a rampant impact on auto component players because A, they have to adapt to those changes by bringing about component innovations, and B, a lot of their business might just become redundant over a period of time. Plus, there are new opportunities, of course, that would open up. So how fast do you switch between opportunities was going to be crucial for that part of the value chain. That brings me to Mr. Kanyappan, who in a way is a representative of that industry today. So how do you see, sir, this entire alternate fuel adoption model that's coming up? And what do you see is going to be the net impact on the auto component sector?
Thank you. Actually, the changes towards CNG actually is, I would say, it's coming back. Some years ago, this was there. And many of the players in the auto component industry, they were able to actually, they were supporting the OEMs with the products and technologies that was needed in that area. But then the industry for some time moved towards diesel, and this was more or less forgotten. But now again in the ICV sector, we see a very steep increase in the demand of CNG, engine-based requirements. Only thing is the industry has to quickly, ramp up supply. The technology itself, I'm sure many of it is already there. For the alternate fuel, particularly the CNG, there is also a 20% mixing, of ethanol. Also is another requirement as another alternate fuel option. But that has come through a very planned and structured way through a regulatory type of discussions, both from OEMs and supply chain. I understand the industry is ready for a maximum of the 20%, because in the BS6 environment, the engines are intelligent enough to understand this and adapt to this changing. May not be fully, but I think that has been a planned move. The CNG steep increase is something unplanned, but industries, I think supply chain is adapting to it. A quick ramp up in the supply chain would be needed to support those products. I don't see it as a big challenge or something. Industry will be able to support. If you look at the electric, I think it's a different ball game. It's a completely different. Yeah. Again, I'm sure industry is preparing for to play a key role in the electric domain as well. Anticipating the trend that is going to come. Yes.
And sir, one follow-on question on this, linked to commodity prices super cycle that you are seeing right now. How do you see auto component players cope with that? Because in a way they get squeezed from both sides by more powerful players of the value chain. You have large players on the commodity side, steel, aluminum, and you also have large players on the auto side. So, how are auto component players dealing with the current parameter of higher commodity prices?
Yeah, thank you. It's a very, very interesting and challenging situation. And it's very unprecedented. We never faced a situation that you'll have to experience that steel will be increased over a period of 1 year at almost 70%.
Yeah.
Only increase, but even availability of certain grades of steel was not there, even though the demand is so low. Again, recently now the aluminum, we are going through the same situation. So you're forced to go and book the capacity at whatever price to protect the your customer lines. As you said, but this is going on in multiple areas. We faced the situation for resin. There was a resin shortage because of certain issues. The winter storm in some part of the US. Then later we are facing a steep crisis on the freight rates. If you're importing, availability of the freight rate itself is high, but many times you're not able to get the item on time because of the increased shortage of the containers and all those things. Multiple challenges. I would say from this perspective, the industry is into a perfect storm. Very difficult. Too many headwinds. The approach we are taking is, of course, requesting the OEMs to compensate. But again, you will never get a full compensation. It's partially you're getting compensated. But the OEM problem is because the demand itself is low. For them, also passing on to the market is still difficult. The other side of the spectrum, as you said, there are bigger players. Many times, in the case of aluminum, some of the alloy elements are imported from China and all those places. Now that is becoming very difficult. Again, availability is a challenge. When you're dealing with the tier 1, tier 2, tier 3 suppliers, they are small. For them to survive in this crisis itself is a big thing. And then on top of that, they are not able to take this burden. So you have to really protect them to continue, keep them alive. It's a very challenging situation right now. So approach what we are taking is to get a partial compensation and then try to, it will have an impact on the margins in the short run. But then, one advantage or one strength of the auto component industry is many of them have their own, mechanism, either through TQM or a TPM or a lean type of, interventions. Also very frugal in their approach. I'm sure over a period of time, the industry will try to improve their productivity to cope up with change. In the short run, there will be problems.
Yeah, so I think Mr. Kaniyappan has made important points. Margins under pressure, not only prices, availability, also a concern despite of weak demand. And, partial compensation from OEMs is clearly what they are getting, given that sustainability for tier 2, tier 3 players is a big issue. Now, while we are speaking about prices, and before we move on to the Q&A session, one last question to Mr. Mukesh, because it is important from a TCO and sustainability point of view for the players who are running logistics operation. Current prices of fuel, how do you believe that fleet operators are able to survive with current price increases in cost of ownership and running cost for truck drivers? What is the difference that you are seeing between large fleet operators and the smaller guys? Over to you, Mr. Mukesh.
Very good question you raised. It's really tough time for the logistics players, during this time when, there is steep increase in the fuel price. And whereas, government want that, overall supply chain cost should come down, which we are very high compared to the European countries and all. So I just explained, basically, whenever there is a fuel increase, happening in the industry, so that the freights, according to the fuel price, are not going up. That's number one. So with that, there is a very hardship being faced by the small player and the big players. Small players, if you look at, I'll share the data of the auto industry, for example. There are total around close to 25,000 trailers which are running with the car industry. I'm just taking an example of car industry to make you understand. And over the time, if you look at last 4 to 5 years, when shift happened from BS3 to BS4, people could sustain themselves. But when the shift was happened from 4 to 6, there was a big increase in the cost. And whereas the customer has not considered any of the cost, which was a fixed cost, apart from the variable cost of the driver salaries, etc., and the fuel price, what are happening from time to time, it's not being passed on fairly. And of course, there's a toll tax, which is also a very big component of the costing. Like, for example, from Delhi to Chennai, we have to pay almost 15,000 rupees as a toll tax only, so which covers up to 15% of the freight. Okay. So the smaller players, auto industry, if I look at in last 5 years, that there's a almost 40% decrease in the fleet. Okay, and this happened in the first time in the industry, like where the old trucks have been allowed to induct in the companies, where they never allowed the old trucks to be inducted in the fleet. Okay, for the transportation of cars. So because of the stress on the transporters, it has come down from 25,000 to 15,000. Okay, so numbers are very discouraging, and no transporter is willing to go and induct the new fleet until unless their freights are being increased or the zero-based costing is being done by the OEMs. Okay, right. Earlier maybe, yeah. So that's the one point. Whereas I was talking to all these OEMs, so they also felt a pinch, and one of the impact of that is, there is a huge number one. Number two, because of the railway also, the OEMs are also, they're playing very smartly, and they are holding not to increase the freight. So this is very well, affecting the all big players. At the same time, the smaller players where, the transport was go 2 to 3 or 4, 5 vehicles, they are operating. So they cannot avail the FCM and all, they are all fleet operators. Okay, they don't avail the FCMs, and it doesn't make them, whether they buy the new vehicles or they cannot take the input cost benefit. So there's all the smaller players, if they are having 5, for example, and if they have to replace any of the truck, so they cannot do it. So the person who was having a ton trucks now is having only 3 or 4 trucks only. Or many of the small players have, have been gone out from the industry. And as one of the participant has mentioned, because of this railway and all, the stiff competition is happening, and lot of hit is being taken by the transporters. So that is going, all these factors, are putting a pressure on the cost also. Because whenever there is an increase in the cost, they always compare with the railway. And with that, they always try to press you, okay, the cost should not go up. Okay. So with that, there is a big impact on the transporters. Large fleet operators also, if you look at Chetak also, we used to make 200 close to trucks, to 300 trucks every year, maybe 400 to 500 also as a replacement. So last 2 years, we have not done any replacement, not even last 2 years. Last 3 years, we have not done any new addition in the fleet, except, maybe a few of the trucks we purchased of CNG alternate fuel just wanted to test in the how it's, going to be economical and all. So with all that, there's a hardship really, which is being faced by the transport industry. And customers, see, there are two ways of looking at it. Customer is not willing to pay more for these services is being received.
Yeah. So, Mr. Mukesh, I got your point. I think clearly fleet reduction has been rampant.
Yeah.
We have also seen that there is pass-through of cost is not possible. So, any addition of fleet can only happen when actually major pass-through in cost happens. And freight rates today are not really supporting that. So on that note, we have actually covered the 4 pillars. 5th pillar being on technology, and a lot of questions which have come up in the Q&A box on the technology side. So I'm going to start directing it to each of you guys, depending upon, what the questions look like. I think the first question clearly is to Mr. Digo. I would like you to come up over here. Alternate fuel technologies, which has been spoken about a lot in this. People over here, multiple users are actually asking that retrofitting, how do you believe this particular market as a business model can pick up? Is retrofitting something which is going to be a new norm that is going to be set in the market from an electric point of view? Over to you, Mr. Digo, on that.
A quite interesting question. Definitely there is a lot of talks going around about the possibility of retrofitting vehicle. Definitely is a solution that in perspective can increase the spread of electric mobility pan-India, considering the huge amount of vehicles that are running on India road. I think, but there are basically two concerns that I see based on the investigation that we definitely as OEM, we have been also exploring that possibility. I see mainly 2 concerns. One concern is in terms of cost. I don't think, honestly, based on our experience, that if you sum up the cost of conversion of a vehicle, existing vehicle, to electric retrofit, if you compare it with the cost and the price, acquisition price of brand new EV, considering all the advantages that are coming out of all the incentive scheme that are there and whatever it is, I don't think that is going to be convenient, as per our calculation, at least at the current level of cost of components of an electric powertrain. If going forward, cost of battery will go down below $80 per kilowatt hour, and we expect it to happen in the next 2-3 years, and through localization of supply chain will be there in India, and cost of electric powertrain will be driven down, it could be that it can be a reliable solution. But the current state of the art, as per our understanding, is not convenient. So it's more convenient to opt for a brand new EV coming out of a factory rather than converting an existing one. The second concern that I see is related to the safety aspect and responsibility part of the story, because whenever you attach who is going to do retrofit, you have to have a reliable agency available in the network to do this kind of operation. And at the end, if anything happens after electric retrofit, who is going to take the responsibility for that? Because that definitely is a heavy intervention. You have to touch the structure of the vehicle itself. And whenever you are doing this kind of operation, it can be that you can create hidden failures that maybe when doing operation of a vehicle after conversion will come out. And so it's not clear who is going to take the responsibility for that. So these are the 2 main concerns that I see. As per my understanding, honestly speaking, I do not see electric retrofit as a convenient solution. I think that it is better to concentrate and focus on rather giving incentive to the customer, further incentive to the customer for scrapping an old vehicle and opt for a brand new EV one. At the end, the result is same. The result is absolutely the same, because you substitute a old, potentially polluting vehicle with a brand new not polluting, and the customer is more satisfied because he has a brand new vehicle that can fly for the following 8 to 10 years. At least this is my view.
Understood. Great. Let's go on to the second question. Rohit, would you like to take that?
So this one is for you, Mohit. Mr. Sri Kumar Srinivasan and Krishna Govindara from Light Metrics have asked that vehicle cost is 8 to 10% of the TCO. How is this percentage changing when it comes to connectivity and telematics? Would you?
So connectivity and telematics solutions are actually getting more and more part of the norm. In fact, I was just talking to a vehicle OEM manufacturer this morning, and the comment that I got was that now they are seeing more and more vehicles rolling out of the plant with as a default, because they would like more. They realize the value of this, and so therefore, and it also prevents the sales team from actually having to offer everything at a discount, and therefore once it goes fitted with this, overall vehicle telematics cost drops pretty significantly.
Okay, so I think that answers questions on role of telematics. Let's have the last question for the session on electric vehicles again. This question, let me pose it to Mr. Mukesh and Mr. Shankar. How do you see charging infrastructure developing from an electric vehicle point of view? Would any one of you want to take this question? Yes, Mr. Shankar?
Yeah, charging vehicle infrastructure has to really take off, and there are standalone players who are coming in that. There are larger companies like Tata Power, etc., getting into this space, and there are many new age companies are coming in. A couple of things in this area would be, one, even the battery technology and the way the charging is to take place can change. And you also spoke about battery swapping. Battery can become as a service. You just go and you take it as a service without battery ownership, and that will be a big enabler for charging vehicle adoption. What we've seen in advanced markets where we operate is that there are a lot of new age companies coming in this space, and technology is also making the charging infrastructure into multiple facets, like how can we have a fast charge, what are the locations that you can have a fast charge. There are parking areas or charging stations that are coming up where people can just go charge and move on. So there's a lot of action that's happening. But while it's like a chicken and egg story, should infrastructure come in first, or should the fleet of vehicles move in faster, is the question that always keeps happening. But I think in this area, the infrastructure needs to take a higher lead before adoption comes in of electrification of vehicles. And I see a lot of at least investor interest and entrepreneurial interest in this area. It's not yet translated into real infrastructure availability per se, but I would say that it's going to be growing multifold in the next 2 years, and that will be a sea change for this whole ecosystem to change, for the adoption to enhance.
Yeah, thank you so much, Mr. Shankar. And many questions that remain unanswered. I think I'm falling short of time. Very interesting panel today. And insights across the value chain. I think that has been, the strength of this panel. Clearly, sir, in the closing remarks, 3 things that come out very, very sharply is recovery curve is not going to be easy, specifically for the MHCV sector. Cost, commodity prices continue to remain a concern, impacting auto component, even auto dealerships. Even fleet operators continue to remain impacted amid higher fuel prices. While this slow and steady recovery happens, a number of structural changes continue. Competition from railways, which is getting more intense. Second, alternate fuel adoptions, which is getting again much more rampant. So at that note, let me close this session. You keep hearing more from us. Thank you so much, everyone. Thank you so much to all the panelists. Thank you.
Thank you, Hital. Thank you for a wonderful moderation.
Thank you.
Thank you.
Thank you.
Thank you, Hital, and thank you, Rohit. Thanks.
Thank you,
Rohit.
everybody.
Thank you, Rohit.
Thank you.